The problem in the world is actually US Treasuries. Their infiltration into the system at every level and every opportunity that makes them the big danger in the world.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast coming to you from Montecito, California. And before we begin, I want to remind you that there is a website associated with this podcast. It's wealthformula.com. Great place to go if you want to participate more in this ecosystem. Sign up for some of our groups, including our accredited investor club. That is exactly what it sounds like. Get an opportunity to see deal flow that you wouldn't otherwise see. If you're an accredited investor, sign up and get onboarded. So today I want to talk to you about currency wars, capital flows, and Bitcoin and all that kind of stuff. Now, I know you're going to hear Bitcoin a little bit, and I know some of you are tired of hearing about it, and you're like, hey, is this a Bitcoin show or what? Stop with that. And I get it, but that's not what this show's about. This week's podcast is actually a broader conversation that touches the entire global economy. But guess what? If you don't know by now, you just can't talk about macroeconomic trends anymore without talking about digital dollars and Bitcoin. Leaving them out is, it's kind of like ignoring gold when, discussing commodities and how they relate to the economy as well. Now, there's a section this week in my interview with Ian Reynolds that we'll have in a moment that dives deep into the bond market and the growing influence of stablecoins. And I realized it might be helpful to give you a bit of context up front. If you're already familiar, consider this a refresher. If not, this will make the second half of this conversation or this show rather more useful. So let's start with this idea of the 10-year U.S. Treasury, arguably the most important interest rate in the world. When you hear people talk about 10-year treasuries, they talk about this because this one number influences everything from mortgages to stock valuations to how much it costs governments to borrow money. And historically, when inflation drops, yields on the 10-year tend to fall as well. In other words, it becomes, those 10-year interest rates go down. That's the standard relationship. Lower inflation usually leads to lower yields. But that's not happening right now. Despite a year of cooling inflation, the 10-year Treasury yield has stayed surprisingly high. Why? Well, the answer boils down ultimately to a simple concept, which is supply and demand. You see, on the supply side, the U.S. government is flooding the market with treasuries, over $1 trillion worth every quarter, to finance its growing deficits. That's a lot of new bonds entering the market. But at the same time, demand isn't keeping up. Foreign central banks like China and Japan, which used to be some of the biggest buyers of our debt, are pulling back. And some are dealing with their own domestic issues. Of course, that's the case as well. But others are deliberately reducing their exposure to the dollar now as a reaction to some of the U.S. foreign policies over the past year, tariffs, all that kind of instability, right? So bottom line is more supply, less demand. So what does that mean? Bond prices go down. And remember, if you might recall, when bond prices go down, yields go up. And those yields are for bond investors. Now, that in turn means those of us who are borrowing, we're borrowing for higher costs because we're not investors when we're borrowing. We're actually paying the actual interest rate. So that applies to, U.S. governments, businesses, and consumers. So that's why even with inflation falling, the 10-year hasn't really followed the script. Hopefully that makes sense. It's kind of a really important concept, how bonds work and how the bond markets and the treasuries. Now, here's where things I think get kind of interesting because there's a new kind of buyer that's starting to step in, and that's stablecoin issuers. Okay, so here's how that works. So what are stablecoins? Well, you're going to hear about them a lot if you haven't already. There are stablecoins, they're older ones called, for example, like Tether and there's US dollar coin, USDC. These are digital tokens, basically, on the blockchain, cryptocurrency, if you will, but they are digital tokens pegged to the US dollar, meaning it's 1-to-1 in value. And they've become essential plumbing for the crypto economy, but their growth is increasingly relevant to the broader financial system. And that's for a few reasons. I mean, they're important in that they're going to make things faster, right? We have like silly things like the SWIFT system and so on. But where they become really potentially significant is that in order to maintain their dollar peg, these companies need to back their coins with something stable. Now, that could be US dollars. Why would they do that? Instead, they can just buy short-term US treasuries. And so, as it turns out, that's actually a great business model. See, these stablecoin issuers, they collect real dollars, turn around and invest them in bonds yielding 5% or more. And that spread between what they earn and what they pay out is just pure profit. It's kind of genius, actually. But here's the thing. That means that there's like these huge buyers of bonds that never existed before, right? And as these companies like Tether and USDC and who knows, any number of other companies comes in, that actually helps our bond markets potentially by creating large buyers. Now, these stable coins are really growing fast. Tether now holds more treasuries than countries like Australia or Mexico. BlackRock has launched a tokenized treasury fund that already has nearly $3 billion under management. And just this week, MasterCard announced that it's integrating US dollar coin and other stable coins for cross-border settlement. Okay, in other words, this stuff isn't fringe anymore, right? Stop thinking it is. Stop thinking it's these crazy kids in their cryptocurrency, because you're going to be left on the sidelines and, the world's going to pass you by. This stuff has moved into the mainstream and it's growing very quickly. Now, even lawmakers are catching up. This month, the U.S. Senate passed the Genius Act. The Genius Act, it's a bipartisan bill that sets clear regulatory guidelines for stablecoins, and it requires full backing by liquid assets like treasuries and regular public disclosures. And again, you've got to have full backing by liquid assets like treasuries. Just imagine, is that whole market grows, and I think it's going to be huge. That is really, really good for the bond market. Anyway, that bill is now headed to the House, and it's not law yet, but the momentum is clearly there. The takeaway, regulatory clarity is coming, and that opens a door for large institutions, payment processors, and even governments to scale up stablecoin usage with confidence. So again, why does this matter for bond yields? Because if this growth continues, and all signs suggest it will, stablecoin issuers could become even a bigger class of permanent treasury buyers than they currently already are. I mean, again, I just mentioned Tether owns more than Australia, right? And that consistent demand could help reduce or at least stabilize borrowing costs for the U.S. government over time, especially at the short end of the yield curve. Now, it's not a magic fix, but it's one of the few credible tailwinds for demand in an otherwise kind of, stretched bond market. And it's coming from a place most economists didn't expect, and probably you didn't expect either, crypto. So with that context, let's jump into this conversation with Ian Reynolds. We're going to talk about not only this stuff, but a whole lot more when we come back.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everybody. Today, my guest on Wealth Formula Podcast is Ian Reynolds, an investment banker and foreign exchange veteran with over 20 years of experience helping investors and financial professionals make sense of global markets, economic cycles, and the big picture macro trends. He's a regular speaker at global conferences and writes a sharp, well-regarded newsletter called Limit Up that breaks down complex financial themes into clear and actionable pathways. Welcome to the show. How are you, Ian?
Very good. Thanks for inviting me.
Well, so let's start with the big picture. Lots going on in the big picture. Where do you think we are in the macroeconomic cycle? And I guess how are some of the global wars and these types of issues, how tariffs, how are those affecting that macroeconomic cycle?
Yeah, so I think that's a really tricky question to answer, obviously.
Yeah, right.
So firstly, markets at the moment have pretty much decided they've had enough of everything, had enough of Trump, had enough of tariffs, don't particularly care about war in Russia and Ukraine, don't particularly care about a war in Israel, Iran, etc., until something happens, because there's too much to price in. You can't price all of those things in; it's impossible. And the underlying factor is, of course, $37 trillion worth of debt as of today, apparently. And how Treasury is going to deal with that, because in 100 days plus, the rate on the 10-year bonds is still the same. So no progress, really. To answer your question, which would be a good thing, I think it's just delaying everything. And the more it delays, the more the reaction becomes more violent once we do understand where we're going. So although it's nice sitting here with nothing happening, it's probably not going to be so nice in the future.
Yeah. So tell me why you think that's the case.
In terms of what's happening in the market at the moment?
Well, no. In terms of why it's not going to be so nice in the future, tell me the components that you're concerned about. What are you looking at? There is certainly, economists out there right now saying that they anticipate a very robust economy in the next few years.
That's right. And there are also many economists who are the other way around, obviously. So as the Fed sits here determinedly doing nothing, and we can say that the other central banks are doing things, but it doesn't matter. As the Fed's sitting here doing nothing, defending its position, global economy is getting weaker. Inflation is based or probably going up a little bit. So the more the Fed sits at the position, the more we're going to get stagflation, as we're now seeing in Japan. And as we know from the Fed, they're pretty much always wrong, and being data dependent really just makes them reactive. That's why they had to raise rates a lot, because they kept rates low for way too long. So if the move up in rates was too violent, as lots of people alluded to, the next move is going to be even more violent, whichever way it is. I don't know which way it's going to be, because I suggest lots of things have to occur, and it's the order they occur that really matters, I think.
So you don't have a sense either way of whether the move is violently up or violently down. You don't have an opinion on that? No.
I don't have an opinion on it, because the Trump or the Treasury could do something wild, like default on the debt, or have a debt jubilee, or we could have a global debt jubilee, which would be the best thing to do. So everybody walks away unscathed apart from investors. But so it rather depends the order at which it happens. If there's a nuclear war in Iran, well, obviously lots of market movement is going to happen. But the US Treasury, if they play their cards right, and they haven't so far, could engineer a happy ending for everyone. But everything has got to go according to plan and happen at the right time. And the more it doesn't, the more difficult it is for that to happen.
Is it your opinion that the Fed should have done something, that they should have perhaps ticked down rates in this last week?
I think rates should probably be 100 basis points lower.
Yeah.
Not wanting to agree with Mr. Trump, but that's actually what I think.
Yeah. Okay. Well, listen, you've spent your career in foreign exchange markets. It's something that probably my listeners probably don't know a whole lot of. But can you break down why currency markets, why they matter for everyday investors, and how do moves in dollars, euros, and yen actually affect purchasing power or investment options for high net worth individuals?
Sure. So currency market is huge, and it means something to everyone. So if we take the 15% decline in the dollar, let's say in the last 6 months, the global reserve currency, that's a massive move for the most important currency in the world. So what does that mean? Well, it means for every other currency, pretty much, their currencies have appreciated against the dollar. That means they're less competitive than US in terms of selling goods. So how that portrays itself in everyday life depends whether you're an exporter or an importer. So in terms of the economy, for investors, if you're invested outside of the US, and I fully understand that lots of investors are US centric, particularly with, the stock markets in America way more, investable than elsewhere. But if you invest elsewhere and you can pick up, a good return on the currency movement as well as a yield, then you're making a much better return. Or it can wipe out, obviously, your yield if the currency is against you.
Sure. So from a retail investor standpoint, like somebody who's got like a Schwab account or something like that, how do you deal with those kinds of currency differences? I mean, obviously we don't have a bunch of foreign exchange traders here. How do you hedge for some of those changes? If you think, for example, the dollar is going down, is that like you try to sort of get into some of the markets that you believe are going to have a stronger currency? Is that kind of the general idea?
Well, that might be the purpose of one thing. In terms of what you said originally about hedging it, so if you really like buying a European bank stock, for example, for whatever reason, and there's no reason why you can't sell your dollars forward. So take a 2-year or 3-year view on it. So you can hedge and already understand the loss or profit you might make from that currency transaction. But then you don't have any risk at the far end in terms of the currency. All you're doing is picking up the yield or the price difference on the stocks that you're buying.
Right now, with the geopolitical tensions all over the place, what are you seeing investors do in terms of reallocation globally? And I guess, how does that affect the markets? For example, I know the U.S. Is seeing a drop in interest in bond markets. So what does that do? And like, how is that playing out? And do you think it's, temporary?
Currently, pool of capital is being allocated towards Europe for the first time, probably since the Euro started, simply because lots of investors have been over allocated to the US in reality, and it's been a very nice ride for them. Well done. But now that doesn't look so certain. So money's coming out of the US. Obviously, some of that is coming out from China, Russia, etc. But a lot of active money is going into Europe. Canada even said they bought less Treasury bonds today, I think it was. So those markets are going to have a wave of capital come into them if what we've seen so far in 100 days plus is going to continue, because you can't afford to be 100% allocated to the US when fighting wars on two fronts, $37 trillion in debt, blah, blah, blah. So that you have to move your portfolio somewhere else. And where do you move it? Europe's cheap. UK is very cheap, seeing some investment coming into the UK at the moment. Japan isn't a good investment. Lots of people think that because their bond market is totally fractured. But certainly more capital will come out until we actually see a decision somewhere, sometime in the future.
In terms of the, like part of, I guess one of the more profound effects of this is U.S. bond market. Talk about that, if you could just kind of give a our listeners a little thought on, what the implications for that are. I mean, we've already talked about, bond yields being an issue right now for borrowers. And obviously the Trump administration wants to see those numbers go down. But there is this issue that if you have less buyers, it's hard to do that. How are we seeing that in the market?
So the first thing that will happen as more decay gets in the system is that simply when the US Treasury offers up $7 trillion of bonds, those yields will have to go higher because investors want to be rewarded by more yield. And on the basis that they've probably got lots of other ones that are lower yield, there's a point where, you have to say that's enough. That's people that are allowed to invest and make the choice to invest. There's lots of people that have to invest, banks, for example, and there's many ways that the Fed helps them out of those haircuts that they get from it. But the first thing is, what is actually happening? They had 2 good bond auctions this week, but we had a failed 20-year one the week before, I think it was. So you don't need too many failed auctions before you're in real trouble. And we already know that the primary dealers who take up a considerable amount of these auctions that are unsold tell us that 10-year goes illiquid at 5% because it's just going to hit the fan. And they've already told the Treasury that. So everyone knows where the line of the sand is, who don't want to get anywhere near that point.
So just so people understand a little bit, one of the things the Fed can do to manipulate those bond markets is to buy up the bonds and make it a more competitive market. And that is called quantitative easing. Actually, the Fed right now, as I understand it, is still selling bonds. And do you anticipate that they'll reverse course on that?
They will pause that, so they'll just stop. In fact, I think they have stopped doing that. And that's why in the last 2 auctions, they came in and bought a lot of bonds. But that's to support the bonds that have rolled off. So they're seen to be in a neutral position. Market is really sensitive to what they're doing with all the balance sheet shenanigans. So the Fed is staying pat on it. If they do QE, then it's monetizing the debt. And it just gets worse and worse and worse. And, okay, you could say we can try and stabilize it by buying 500 billion of treasuries. But if we have to buy 5 trillion of treasuries, quite clearly the market is going to collapse on them.
For years, obviously we've got gold as the go-to inflation hedge. You have an interesting thing right now where Bitcoin has kind of come online as a legitimate asset. Talk to me a little bit about how you see gold in the rise of Bitcoin. I think a lot of retail folks still are a little bit wary about the idea of Bitcoin. Should they be? Give us a thought on gold and Bitcoin.
So gold is the 5,000-year asset. It keeps going up. And it's been going up a lot in the last year and quarter, sorry. And the fact that gold goes up like that and has often decades of growth is because the global economy is in big trouble. The reason why Bitcoin was invented was because the global economy was in big trouble. So those 2 things are perfectly aligned, but one's old and one's very young. One's still growing as a network effect, and has had some capital in it so far, but not a lot. As Bitcoin consolidates above 100,000, which is obviously a big thing for retail investors, even institutional investors, to be honest, the more it's likely to go to $1 million. I know that sounds too simplistic, but we get happy with it, right? Getting above 10,000 was a big thing. And then at 100,000, bashed our heads on it a lot.
I would just say what I think is interesting. I would love your comments on it because I am I'm following Bitcoin very close. I actually have been in it for, since 2017 myself. And the phenomena that I feel like is happening right now is it's really, even though Bitcoin is now steadily over 100,000, right around 100,000, in many ways, from an investment standpoint, it is potentially a much better risk-adjusted investment today than it was when it was sitting at 10,000 or 6,000, because you have this entire milieu changing where you have, nations buying Bitcoin, you have ETFs buying Bitcoin, you have BlackRock, you have major reserve companies. And then at the end of the day, there's only 21 million Bitcoin ever going to be. And a lot of them are in the trash already.
Yep. So yes, it's a fixed supply. Some institutions are buying. There's a lot of leverage in the system now from Saylor and MicroStrategy. I don't like that at all. That's got to unwind. And now we're seeing arbitrageurs trying to sell that trade. So typically for Bitcoin in the 4-year cycle, which some say doesn't exist anymore, but seems to be still going right here, right now. Just look at the charts. It's not wrong till it's actually wrong. We've got 6 months of price appreciation till something has to happen. So I don't see why we can't have another blast higher and then a top for another 4 years. It gets smoothed out the more market there is, the depth of the market, which there certainly is a lot more now. So as we've seen this cycle, the drawdowns have been significantly less. So we could certainly reach a point where it plateaus, I think, for quite a bit of time. And that's probably a good thing. It probably will, in time, be like gold, where it, in terms of the world economy, when it's in a bad way, it will go up a lot. And then when the world economy seems to get its act together, it will plateau and then go up again.
Well, let me ask you this, because you have a very, global perspective compared to most of our listeners, and you're much more, you're tapped into the institutional side of things. Tell me about like how people are viewing the Bitcoin now, like the professional investors, the institutional investors, this quote unquote smart money. Are they dealing with it as a speculative asset, or are they dealing with it as digital gold?
Or are they just trading it? So hedge funds are just trading it. Fund managers are applying portfolio metrics to what they're doing. And of course, with Bitcoin, the problem is its value always goes up, which is the problem, because they've got to chop down their allocation unless they rewrite their rules. I would say that in Europe and the UK, there is pretty much no fund management investment in it. So hedge funds, traders, absolutely. But we're well behind over here. Australia has got some investment in it. But I'm thinking that lots of the investment actually is coming from Japan and China.
Interesting.
And when you've got capital controls, then you'll want to get it out.
Now, with Japan, is that because of the the terrible yield in the bond markets and all? And they're very yield starved in Japan. So is that the idea?
Part of the idea, and they've been yield starved for 40 years or something.
Yeah.
And anyone that's bought a JGB will tell you how much of a haircut they've had in 40 years. So where do you go? What can you do? Well, Japanese are technologically very savvy. They're not resistant to change, as are Chinese. Like Chinese, unlike Europeans and surprisingly the UK. So the center of capital and liquidity for markets is well behind on investment in Bitcoin, even though the FCA has a very good sandbox for them to test crypto technologies mixed up with traditional technologies.
So why are they behind? What are they waiting for? Are they just not convinced? Why are they not in?
Well, in the EU, everything is slow and everything has so many rules, and you've got to fill in so many forms to do anything. It's just they expect the US to prove it for them first, but the US hasn't been able to do it because of the laws, particularly in the Biden government, stopping widespread adoption. Obviously, Trump has come in and done that, and we haven't really seen that come into effect yet, but it will spur a lot of investment into America, I believe, at that point. a lot of money will flow out of Europe again and into America for those very reasons, because as America adopts it, does all the usual. The first one puts all the rules in place, makes all the mistakes. Thanks very much. I will come and invest in you.
Interesting. Well, let's move. I end up always wanting to talk about Bitcoin these days, but so I want to keep making sure that I cover some other things. So one of the things you mentioned earlier, that central banks around the world, they're not moving in lockstep, right? So what does this policy divergence mean for investors with international exposure, whether it's real estate abroad or global equities?
Yeah, so we've seen since the Fed stopped cutting after 100 basis points and the ECB started cutting, and we could say the other European central banks as well, we've seen the euro against the dollar go up considerably. So in fact, it's broken a secular decline since it was started to exist. And there's really no reason to do it apart from exactly what you just said, because currency pairs are a result broadly of the difference in interest rates overlaid with political risk and all that other stuff. So if the fundamentals are changing, it means you can get probably a significant run at it, rather than if political risk comes off and goes on again, that's rather transitory. Don't want to use a J. Powell term, but when interest rates turn, one going one way, one going the other way, you're likely to get a sustained benefit from that.
Kind of moving towards your newsletter type, and to tell us a little bit about the newsletter first and foremost.
Yeah, I started it 2.5 years ago. It's to help investors understand what's going on in the world without having to digest 96-page PDFs. So there's a weekly newsletter which talks about countries, and there's a daily update which talks about markets. So it is an evolving story.
So one of the things that I think you've mentioned is that institutions often get the first crack at macro tailwinds, right? So is the idea behind the newsletter to try to keep investors on a level playing field, or?
Yes, I mean, lots of my viewers were astonished when I started saying this is why I like gold 2 years ago, because everyone had totally ignored it for 4 years, 5 years. And so I started mentioning why the charts are looking good and all that sort of stuff. And everyone's saying, well, why are you even talking about it? It's completely irrelevant. And I said, well, I don't think it is. If you go and look at what gold is telling you, it's moving up. There's a reason why it's moving up. And China's buying lots of it. Actually, Poland's buying lots of it. Actually, all the central banks are buying lots of it. We're going into a situation with the Basel III and how all that plays out. And we're going into a world that is so in debt, it's ridiculous. There's something going on here, and gold is telling you that has started.
What's one macro theme or contrarian idea that you're tracking that most people right now, like you just mentioned about gold, even smart investors might be missing right now?
So I'm not convinced about stable coins that people, I mean, I get the idea. It's fantastic. And lots of Asian economies live off it, right? Because it's a great idea. You can instantly transfer money and it settles immediately. If Scott Bessent thinks he can create 3.7 trillion adoption of stable coins in the US and it's going to buy US treasuries, I think that's wrong. Because
so back up on that, because it's a really interesting idea, and I don't think people know. First of all, we should probably start out with this. The stable coins are essentially a digital asset, that you can get US dollar coin, for example. It's backed by a company called Circle, who owns an equivalent or more US treasuries to back up that. So it's effectively allowing you to move this money around very, very quickly. So why don't you take it from there and kind of explain what the idea Bessent has and why you don't think it'll work?
Yeah, so effectively, it's just like the GLD ETF. It's backed 1-for-1 with physical bullion. So it is worth what it is because it has underpinnings of that value. So Scott Bessent sees with Mr. Trump's agreement that stable coins can be the next revolution in finance. And there's nothing wrong with that idea. But he thinks, and Trump thinks, and of course they have to say this, that a US dollar stable coin has to be backed by US treasuries. But my
and the thought is, well, then you get a big buyer of treasuries, right?
100%. So they
right.
reckon 3.7 trillions worth, right? Who knows what it
Right.
is, but they reckon that. But the problem in the world is actually US treasuries. There's nothing wrong with stable coins, but it's the US treasuries and their infiltration into the system at every level and every opportunity that makes them the big danger in the world. And those are the things that are causing all the trouble.
Understood. But I guess what the thought here is that, you put these massive, amounts of money into buying, those treasuries that, that's going to help those bond markets come down, right? And so why wouldn't it?
Because the very problem is those treasuries itself.
Sure, but there's buying pressure, right? And I guess that's what I'm confused about.
Yeah. So as the creditworthiness of the United States declines, which we've seen some tailwinds from previous things with Standard & Poor's recently, the willingness for people to buy treasuries on a lower credit rating than Microsoft suddenly is up for question. So if you put your money in a bank, that bank somewhere down the line has to buy some US treasuries with it. But the more US treasuries go down, the more the system implodes. So I think that they won't get to 3.7 trillion adoption, and who knows what the number is anyway, because the US treasuries are actually the big problem behind this, and that money may well wash out of America again once that occurs, which is why I'm saying all the outcomes of all of what I'm talking about really depend on how they happen in the timeline. That's why it's impossible to know what's going to happen in 5 years without knowing what all the events are and what order they occur in.
Well, I guess that's something we're going to figure out pretty soon. Let's just remind our listeners here, your newsletter is called Limit Up. Where can they get access to that?
Currently, it's on LinkedIn.
Okay. So just follow Ian Reynolds at LinkedIn, and you should be able to get the access to that.
That's it, yeah.
Fantastic. Thank you so much for your perspective today. Appreciate it.
No worries. Thanks for having me.
Be right back.
You make a lot of money but are still worried about retirement. Maybe you didn't start earning until your 30s and now you're trying to catch up. And meanwhile, you've got a mortgage and private school to pay for and you feel like you're getting farther and farther behind. Good news. If you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator. It can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Hope you enjoyed it. Lots of interesting concepts there, right? I still think it's critically important for you to keep an eye on this issue of stable coins. It's funny. I'm going to just point out that there was a USDC is issued by a company called Circle, and I was really interested in potentially buying some early stock in this company, and was looking at pre-IPOs and all that kind of stuff. Never kind of got in, and when it hit the market, I saw it and it was trading. It went from $60 all the way up to it was like 107. And I thought, well, gosh, I don't know if I should buy it now. And of course, a day later, Coinbase made some announcement, and the Circle was up to over 200. I think it got up to $250. But keep an eye on the space. I'm not suggesting you buy stocks or anything, but the whole world is going to completely change in terms of how we do business. I mean, wire transfers, all that is going to be different, right? I mean, why would you have hours? I mean, when you can wire money, when you can, settle money across borders. I mean, if you can just quickly deliver money in real time, and without a third party. I mean, it's huge. Anyway, that's it for this week on Wealth Formula Podcast. This is Buck Joffrey signing off.